If you go back to last year when the Sell America trade was all the rage, the fact is that this country continues to be the prime destination for capital in varying degrees. Now, look, the global portfolio reallocation after literally a decade of overweight U.S. is something that we think has begun. It's moving very slowly, but frankly, the sell everything, sell America type theory really doesn't tend to hold much water.
You do, though, wake up to headlines like we saw on Saturday with President Trump threatening further tariffs on European allies, thinking, how do I hedge, right? How do I at least protect myself on the downside? With the VIX, holding under 20, the MOVE index just comes down, 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 down. There's no volatility in this market. How do you protect yourself? Where is a safe haven? Well,
it's options on literally every asset class globally have been extraordinarily inexpensive. I mean, we've been scratching our heads for the last 2 weeks, wondering how the VIX could have been 14 and 15 to start the year, how the move, to your point, is at multi-year lows. And essentially, from our point of view, option strategies, puts in a lot of these things make a ton of sense. But the key is hedging, not selling, because the underlying subtext of this market is the same that it's been for 3 years. AI is going to drive equities higher when we get to the end of this year.
Julian just came out with a list of market surprises, potential market surprises for 2026. And what I love about this list, Julian, is that not only do you highlight what could surprise, but also how to play it. And of course, we protect the copyright of our guests, so go ahead and look at Evercore ISI website for that. But or subscribe to Julian's research. What would you say has changed over this weekend? I mean, if you were going to write this list again this morning, would it be different than on Friday?
Well, we would have probably bumped up the potential for the U.S. taking control of Greenland from number 7 a little higher in the pecking order, although the prediction markets are only incrementally assigning a higher probability. And of course, our trade there is to own Euro Stoxx 600 puts, which certainly have done their share of the heavy lifting these last 2 sessions. And then the other one, I think, and this complicates what's going on in Greenland a bit more, is our view that there's a potential for the U.S. 10-year yield to trade above 5% in 2026. Now, 2 things. Obviously, the surge in yields in Japan is difficult for our markets to digest. It plays into this more cautionary narrative around asset volatility with regard to Greenland. But again, it just points out the fact, as it was last year, that part of the underlying strength of the U.S. market is our ability to keep interest rates in check.
So does that mean that the sell-off that we've seen in Japan, how are you weighing it in terms of what has been the driver of the market for today and what that means for the driver of a market going forward? On a down day like this, is it more important to have the geopolitical concerns that maybe Europe is going to be hit with more tariffs, or to have Japanese bond yields hit the highest on record?
Well, on a down day like this, you would prefer to see fixed income acting as a shock absorber, right, not a shock accelerator. But obviously, again, Japan changed that narrative. It's going to be, in our mind, if we get to that 4.5% level, where, if you think about what happened last year, that was the type of level where the Trump administration started rethinking its approach to tariffs. Do you get that kind of rethink with regard to what's going on in Greenland? Today, Trump appears to still be in sort of acceleration mode on the subject, but things are moving very quickly.
I want to focus in on the U.S. debt market, because Ann Walsh said this fundamentals are strong, and it's almost like a throwaway comment that a Treasury Secretary would make about dollar strength. I mean, are they really strong? Are they stronger than they were a month ago or a year ago, as we have debt to GDP ratios of 100% plus, 6 to 7% deficit spending outside of a recession, and that with 4 to 5% interest rates? I mean, it doesn't seem that strong.
And the sum total of what you've just said from time to time has certainly been something that's roiled markets. And again, and I go back to the establishment of the Peterson Institute, I think 40 years ago, to deal with the concept of the debt problem. And here we are 40 years later. It's a much larger problem, but again, it's going to not be a problem until it is, from our point of view, creating incrementally more geopolitical instability creates a greater chance that will be a problem, but we do not see that as a discrete problem in the medium term.
Is it an issue, though, that we came into this year with a lot of bullishness, a lot of confidence, whether it came to overall markets, animal spirits, deals are back on? We were talking about this in the break, that Bank of America's latest fund manager survey shows the lowest amount of hedges since 2018 for equities. Cash levels are at record lows. You were talking about this idea, you don't sell, you want to own options, but it's an issue that people aren't doing that they don't seem to be protecting themselves to the downside. So
our surveys team will poll clients, and the first week of the year, the question was, where's the next 10% in the S&P 500? 75% of the respondents said higher. When we've seen that kind of one-sided viewpoint over the course of last year, we've had pullbacks. So in that sense, it's absolutely not a surprise. And again, for us, it's just a question of, particularly at these valuations, because in the fourth year of a bull market, at these elevated valuations, let's call it imperfect news, which we're facing this morning, is going to cause more volatility.
Let's talk about AI for a moment, because you highlight that. Obviously, that's been the driver of these equity markets for a few years now. Is there a risk that the massive funding needs are difficult to meet, especially for a company like OpenAI, which wants to spend over $1 trillion and only has, I don't know, 20 billion in revenue? How do you square that circle?
So we look at the universe in general, and the spending, for the most part, from the hyperscalers is very, very sustainable as regards to the free cash flow. Obviously, at the private level, those numbers are a little murkier, but the deal pipeline continues to suggest that it is not an issue. And I think essentially what it comes down to is, how do markets digest news? And I think to the point, earnings season share price reactions, particularly from the hyperscalers, are going to be very, very important. And from our point of view, the mood has soured in technology and AI over the last 6 weeks, enough such that the bar is set actually lower for tech companies than it is for the rest of the market.
But is this debt issue a lot like the Treasury debt issue, where it doesn't matter until it does? Is it that binary, when all of a sudden someone says, oh, this matters? Can we see a total lack of confidence?
Well, look, something like that is possible. But again, go back to December, the company that has clearly taken on, very large levels of debt to finance its plans, it was idiosyncratic. That company's credit default swaps surged higher, but the rest of the credit space and the hyperscalers were largely unaffected. And when you look at the NASDAQ 100, the net result, as we've seen on several occasions during this bull market, is just a sideways churn. And we think that's where we are. Ultimately, we do think all of that's going to resolve higher.
But this gets back to something you put in your list of surprises. And I love how you started this saying, have we as investors lost the capacity to be surprised? It does kind of feel like that, Julian, that you get these momentary bouts of concern about momentary bouts about geopolitics or tariffs, but we end up buying the dip and we end up higher. Have we lost the capacity to be surprised? Do we just now have this Pavlovian urge to buy the dip and nothing matters?
Well, that's why this morning is such a stark reminder, okay? The overenthusiasm was exactly that, overenthusiasm. But when you think about the fundamentals of a year where earnings are likely to grow at least high single digits, if not low double digits, where you're going to have lots of stimulus in front of midterm elections, and you're going to have an economy, we just raised our GDP forecast to 2.5%. And even then, the risk potentially tilt to the upside. All of that suggests that things are going to continue moving to the upper right, but this is just a reminder that it doesn't happen in a straight line.
But do you worry that it's a fragile house of cards? I mean, as long as everyone's on board, right? There's no bears. As long as everyone from Ann Walsh to Ed Hyman says it's okay until it's not, like we're going to buy the dip.
And again, days like today don't concern us discreetly. This is a logical reaction to, an unprecedented change in geopolitical configuration. Prospectively, it would be more concerning if the market just laughed this off. Then you would get to, ultimate FOMO, really over-enthusiasm.
Still not a lot of change, Julian. You have the President of the United States essentially threatening military action against NATO to annex a territory, and yields don't move. I mean, more than 5 basis points.
Well, but again, you also have to remember that the interest rate markets has been very, very calm.
Yeah.
There too again, and obviously creeping up in the last week or two, there too again, you're likely to have further upside. Probably episodically, we need to see the next round of data accompanying whatever the ructions are coming from Japan, coming from Davos.
This feels like an awkward question to ask on a very down day when things like small caps are down especially hard. But if this is a year that's going to be led by earnings, that's going to be led by stimulus, is it also a year where leadership broadens out?
So you've seen that these first couple weeks.
Sure.
And our problem with where the market is right now is we believe this can be an everything works year. But if you do the math, everything still needs to be led by technology, AI, et cetera, whether it's the weight of the top 10 at 40% of the index or the weight of the hyperscaler slanted sectors at 55%. But again, like we saw at the end of the internet bull market the last year or so, you had an everything rise. The problem is now is that the first reaction in areas like small caps and cyclicals, where we've seen a lot of buying these first several weeks, is that this narrative of what's going on geopolitically is a bigger threat to the growth trajectory and the pricing in of greater growth than it is in terms of a technological headwind.
By the way, I just want to bring it back quickly to WSL Predict. This is the function on the Bloomberg that I've been looking at so much recently. Rick Rieder's chances of becoming the Fed chair now in the betting markets up to 20% over the weekend from like 5%. Does it matter? Does the Fed matter that much to your outlook for this year, or would it be fine if it just stayed on hold?
A fellow Emory Business School graduate? Great for Rick. Look, this is just another one of these things where the saga is ongoing. We're going to get a name at some point. And, I think the market would be reasonably comfortable with whoever's going to end up crossing the finish line.